Trends are simply, think of it much like trends in pop culture. Things are tending to go in a specific direction. So when somebody says that a market is in an uptrend, as you would imagine, it means that the market is going up over time. Pretty basic stuff. Trends, though, can also be downtrends. So, for example, this area here on this weekly chart was most certainly in a downtrend. As we were falling, we fell from 138 US dollars to 120 Canadian dollars by the time we got to the downside. But since then, we've been in an uptrend. And that brings us to another possibility, and that would be over here in what they call consolidation. Just means the market is consolidating its gains or losses. In this case, the market had been rising for some time in an uptrend, and then we consolidated a bit, kind of digested our gains, pulled back a little bit further, and then rallied to the upside. Now, the problem with trends is that people will use multiple time frames to define the trend because you know what? This is a weekly chart of the dollar CAD, and you can see that we were in an uptrend. Now, we had pulled back a little bit here, but on the weekly chart, this is merely a correction. I mean, you can see that there is still an argument to be made for trend lines being part of the chart. You know, even with this pullback, we've held the trend line. We didn't break down through all of this previous noise here that had been resisting gains. So that's a correction. It's not a downtrend. This is a little bit more of a downtrend because it was much stronger. There is a little bit of a judgment with this, and that's part of what makes defining the trend a little tricky for some traders. So let me go to the 15-minute chart. Clearly in an uptrend here. Clearly, you know, you could say in a downtrend there, but really, when you look at this fall, you're talking about a few hours. You're talking about 120 pips or so from the very top to the very bottom. I mean, yeah, that's negative, but that's hardly the long-term trend. So when you look at trends, the most important thing to focus on is, I would say, probably the weekly trend, if not the daily trend. There are certain moving averages that people tend to follow. So on TradingView, for example, you can go to moving average, go to exponential, and a lot of times people will use the 200-day. That's because it represents a year of Monday through Friday trading. It goes back to the stock market. And they will follow the overall 200-day moving average. So as we are rising at this point, we're in an uptrend. We were definitely in a downtrend then. You can see that it even offered a little bit of dynamic resistance and support occasionally. So that's one way to look at the trend. Now, there are other moving averages that people will pay attention to, such as the 50 and the 100-day moving average. And they will even extrapolate this stuff down to the 15-minute chart. So, for example, they may take like a 20 moving average, and you can see that that when I put a 20 moving average on this chart here, it moves much quicker on the 15-minute time frame, but it does give you an idea of what the short-term trend is. As a general rule, you want to follow the longer-term trend. You do not want to get stuck in the minutia. So, for example, if you saw something like this on a short-term chart, but we were in a longer-term downtrend, then you think of it more as a correction. You think of this as an opportunity to short from a higher level. You simply must stick with the higher time frames if you wish to be successful. Going back to what I was saying about consolidation and how the market will sometimes digest gains or losses, we could take a look at this level here and this level here, roughly 115 and 114 in the Swiss yen on the 4-hour chart. So you can see for several days we didn't go anywhere, but that does offer short-term trading possibilities. You know that you came in here through an uptrend. Typically, consolidation does mean continuation eventually, But in the meantime, a lot of traders will trade back and forth. Comes down to what style you're looking at. If you're looking for short-term opportunity, then that may work. Or you just simply look for a breakout of the consolidation that has formed itself, because you can see we continue to go further. If you're familiar with, rectangles, for example, it's the same idea. It basically is a rectangle. Consolidation is just where the market can't go in one direction or the other, but it does typically continue in the same direction it entered. So in this case, up, and of course it did. Now, it works in both directions, obviously. You can consolidate. This was a small consolidation after a breakdown, and we did continue to go lower. Consolidation just means there is no trend, so you're looking more of a range-bound type of system. You just go back and forth. A lot of times you cut your position size down and just simply scout the market. Now, that is when short-term trading back and forth can be very profitable, but you want defined support and resistance. So in this case, you could say something to the effect of, well, we've hit this line 4 or 5 times, we've hit this line 4 or 5 times, and you go back and forth. You could even choke up on it here and say that we were in even tighter consolidation to kick this off. So again, it comes down to finding places where markets won't go above or below, kind of banging around for small trades, knowing that you're not looking for the world there. And then once you break out of that, basic tools in the technical analysis world, you should know how to use all of these, and therefore you can set up your charts, because technical analysis at its core is simply marking up a chart with layers of interest, areas that you may want to buy or sell, areas you want to avoid, that type of thing. And using these tools allows you to do just that. I'll be taking a look at levels. I'll be taking a look at trend lines, and I'll be taking a look at channels. So first of all, I would describe a level as simply a price. It's a level on the axis going horizontally on a chart. You can go to the menu over here, click on the line tool, click on the arrow for the sub menu, and go to horizontal line. By doing so, you can then click on the chart and place a line. You can place it wherever you want. You'll notice that the bubble has appeared. So if you hold down the mouse and button and scroll, you can see that the price can be moved back and forth as I am doing here. You can also, for example, right click on this dot and then go to format, and you can change the price manually. So for example, if I want 6,500 even, I just click on that and it'll take it right there. I can also change the style and all of that as well. I can thicken the line as you see behind you. I can change the color as you see behind you as well. And that allows you to customize the charts however you wish. The nice thing, once you click away, you can click on the chart, and then it becomes inactive, and it will activate itself again if you hover over it. If you change time frames, so let's say I want to go to the weekly chart, it stays right where it was. So this is an important way to mark up the chart to give you an idea of important levels down the road that might be on higher time frames, that may be market turning areas, but on a shorter time frame you may not be thinking about. The next markup would be the trend line. Again, go to the line menu, click on the arrow for the submenu, and then click on trend line. Trend lines are similar, but they are diagonal in nature. So you click on the chart, you hold the button down, and you drag right along. Click it again, and then there's the line. Again, you can format it just as you did the horizontal line in color, thickness, that type of thing. So you can see that this is an area where price continues to bounce from. That is an uptrend line. The exact opposite is a downtrend line. So, for example, you could draw it there, and you can say that price has not been able to break above there. So that's the second very important markup that you'll need on these charts. But one thing that I would do before I go on to channels, this is kind of messy here, so let's go ahead and clean it up. Right-click in the chart somewhere away from any of the drawings. Go to remove, and then remove all drawing tools, and you have a fresh, clean chart again. Now, for channels, you may notice that in a particular part of this chart, we have a channel going, and a channel is simply that uptrend line that I had mentioned previously, but it's got a parallel uptrend line. And you can see that in this area here, you could have bought, sold, etc. And there's an entire theory of trading behind channels, and that's why they're so important. You can do it one of two ways. You can do it using just regular trend lines, or, like that. Or you can use the tool for parallel channels, which will give you a perfect parallel channel, which is really what you're looking for. You can click on the submenu in the line chart for parallel channel. It functions very much like a trend line in the sense that you drag it, and then when you go to close it, you drag it, in this case, up, and you can see that there's a purple area. And of course, you can format this just as you can any other drawing. So let's go ahead and make that a little bit lighter color. Maybe something like that would be the lines. And then the middle, you can change that as well. The background, you can just take that out. In this case, I'm going to lighten that up to kind of a salmon color. And you can see that's completely changed. The middle line has appeared because I did that. And that opens up a whole new world of trading possibilities going back and forth between the buying and the selling. These are very important drawing tools to understand in the platform, and it'll give you a leg up on marking up your charts. Again, as I previously mentioned, these do transfer to other time frames. So if there's an area that has been important previously, it could be in the future, and that's what technical analysis is all about. So stick with us. In this next video, we'll talk about support and resistance and the importance of that. So support and resistance is exactly what it sounds like. It is support for price or resistance to price. So for example, a place where price won't drop below. So that is support there as the market continues to find buyers in this general vicinity, just as this was resistance as the markets kept trying to break above there, but could not actually accomplish that. Now, support and resistance tends to form at large round figures, and as a result, you can use that to your advantage. In order to do this on TradingView, you click on the line tool, the horizontal line tool, and then you just place it right on the chart. You can drag from the oval here, and this brings up something a bit interesting. So, as you can see, I can right-click this and go down to the settings, the coordinates. I can make it 240 even, and most of the time you will find that price tends to respect these round numbers, like I said. Now, there is an area that has been supportive, a little bit of a range here, just below 240. And as we broke higher in Ethereum on the daily chart, we finally plunged through it, and it offered resistance. You quite often see that. It's market memory. So what I use to illustrate this a lot of times will be the idea of a high rise. So say you've got 4 floors here. Floor 1, floor 2, floor 3, floor 4. And if you take the stairs or the elevator up to the second floor, what was once the ceiling now becomes your floor. Just as if you drop from the 4th floor to the 3rd floor, what was once your floor becomes the ceiling. It's kind of the same thing in technical analysis. Let me go ahead and draw a couple of other lines, and you will see that as I draw these out, it becomes apparent that this market, Ethereum, seems to like these levels right around every $40 or so. You can make an argument for these are areas you should be trading from. Now, quite often what people will do is they'll look for support or resistance in the marketplace on higher time frames, and then perhaps drill down to a lower time frame to see how it behaves. That's getting a little ahead of where we're at now, but what this does suggest to you is that markets, in fact, are not random, and they do have little roadmap, kind of like posts and signs. You can think of it as opening up a map, seeing that there are directions, there are turns and twists in the road, very similar here. By simply drawing these 4 lines, you can see how different the market suddenly looks. And you will find that this is the case in pretty much anything you draw. So this is the letter X. This is U.S. Steel, common stock. I can go ahead and draw that there. And I can right-click on the circle, click on Settings. I can change that to 25, just to make it 25 even. You can see that price does seem to respect that. That was support. It finally broke down, and look, it became resistance later. That's that changing floors kind of analogy that I put. So let's take a look at $20, for example. You can see that the market certainly respected this. You can also see that it's not to the penny. It's a general idea. So that's where you mix in technical analysis with trend analysis, maybe candlestick analysis at these crucial areas. You know, you don't just go in and start selling or shorting at $20, expecting it to never go to $20.01. It's just a guideline, but support and resistance, without a doubt, probably one of the most basic, if not the most basic, actual basic form of technical analysis, but it's also one of the most crucial. And in fact, a lot of professional traders simply will mark up their charts like you're seeing me do here, and then look for the right candlestick. Now, we're going to marry that with the idea of Fibonacci retracements and extensions, and we'll see how that works down the road. But I want you to, as a little bit of a homework assignment, open up as many charts as possible, just like you see me doing here, and draw lines and see what you notice. See that it repeats. See that these are areas that are support and resistance over time. You know, you'll notice that it breaks up. The head and shoulders patterns are easy to see, and that's what I like about them, because you want patterns that are easy to identify and that the market will pay attention to. The first thing I would say is there is an inverse and a standard pattern. The head and shoulders is actually a negative pattern. It's a bearish pattern. The inverse, of course, is just the exact opposite. It's bullish. A head and shoulders is a pattern that shows a rally, a trough, a rally, a trough, and then a rally and a breakdown. These are the shoulders, rallies 1 and 3. 2 being the head. You can see that it's taller than the shoulders. There's a neckline where traders will identify a breakdown point. It'll look a little bit more like this. And on a break of that neckline, you short it in this case. Or if it's inverse, it'd look more like this. The head, you know, just it's upside down. The head's taller than the shoulders, which makes a lot of sense. I would also point out that it does not have to be straight up or straight down. It can be at an angle like this. And think about the psychology of this. You have a market that's moving in a particular direction. The buyers feel good. There's a little bit of a pullback, and then they rally it again. And at that point, if you're in on this shoulder, you think, okay, good. The trend's working out in my favor. Everything's good. These people recognize that it's an uptrend, and they want to get in on the action. They see a little bit of a pullback, but they're not worried. This is a market that's been moving in their direction for a while. Then the next rally shows a little less enthusiasm. Well, these people are losing money right away. And once we break the neckline, which was the beginning of this rally or the beginning of the pattern, these people are all losing money. Well, what do you have to do when you're long of a market and you're losing money? You have to get out, and you get out by selling. So it puts even more downward pressure here. The exact opposite would be true in this scenario. The sellers feel good. They get a little bit of a pullback. We're even lower at this point, so it certainly is working out. get a little bit of a pullback, wouldn't be too worried about that, but all of a sudden, the market can't go as low. Once we get past the neckline, everybody in this pattern is losing money. So they have to buy to close out their position, creating more upward momentum in this direction. So let's take a look at a couple of examples. On this chart, I see a head and shoulders after this is a 4-hour of the cable. After a rally to the upside, you can see that we rallied again and then rolled over. The neckline would be this entire area here. So when you look at this, you can see that the buyers felt good, and then they pulled back a little bit, which is, it's normal. And then they rallied even further. So, of course, they're feeling good about their trade. But the other shoulder, showed signs of weakness, and that has people nervous. Everybody above the neckline now, once we break down below it, is losing money. So, one of the things that makes the head and shoulders so valuable, to me at least, is that there's a measuring stick. I love patterns with measuring sticks. You take the tallest part of the pattern to the neckline, and in this case, it's about 110 pips from 132 to 130.95 or so. Once you break down below the neckline, you are moving the height of that pattern in theory, and that would be your target. And you can see that clearly it worked out. And in fact, it worked out much better than that. It kept going. Stop losses are easy. You just put them on the other side of the shoulder, because if it turns around and breaks above the top of that shoulder, that's the breakdown shoulder, well, clearly the pattern didn't work out. So that is an example of a head and shoulders. Now, an inverse head and shoulders, as you know, is just simply the same thing, just other direction. We have that pattern here. You can see that we started to fall. The sellers felt relatively good. They feel even better there. They don't feel quite so confident there. Once they break through the neckline of the head and shoulders pattern, in this case, you've got a move of about 220 pips from the breakout at 142-ish. So you're looking for about 144.20, about there. You can see clearly it hit that. It went further, and that's not uncommon. A lot of times it'll overshoot. But the pattern would be easy to trade in that scenario. You would have your stop loss set there underneath that shoulder. You'd have your target set there. You would either take your entire profit there or take half, or at the very least be at break even. Head and shoulder pattern are great because they're easy to identify. Everybody in the world knows what they mean, so therefore everybody pays attention to them, giving more credence and more of a self-fulfilling prophecy. And as it sounds like, a double top is 2 times hitting the top, or a double bottom is 2 times hitting the bottom. Simply a price that the market can't get through in either direction. Sometimes you'll hear them referred to as M and W patterns. They're very prominent and important signals once you get them. They don't have to be to the point. Doesn't have to be the exact same price, but you want them close. They are reversal signals. This is a bearish reversal signal showing that we can't get above this level here, and this is bullish. So looking at the chart, you can see clearly that we had been breaking down, and there's 2 areas here on Johnson & Johnson on the daily chart, right around, I'd say around 110, 111. The market can't break above, and that's a good sign that the buyers are going to take over again. You can play this a couple different ways. This is that W that I had mentioned previously. Some people will wait for a break of the W. Now, that's an extraordinarily cautious way to play. But the idea is you can extrapolate. This is 111 to 120. That's a $9 move. So you're looking to hit 129, and that's exactly where we go to right off the bat. However, I prefer to play it as such. I see the double bottom, And as soon as I see us break what would be the middle of the W, I go long there. I still wait to see if we break out above there. And once we do, I still extrapolate the same move as if I had gone long on a break of the W. This gives you, in this case, an extra, say, $3 or $4 on the trade, which can make quite a bit of difference on 100 shares, $300 or $400, or $1,000, $3,000 or $4,000, that type of thing. So that is an example of a double bottom. Over here, we have a double top, and it works the same way. You can see that clearly in Wayfair on the daily chart, we could not get above $150. I like this trade a lot because 150 is such an important psychologically large number. You can see that we do have the M pattern here, and right at the 130 level, you would have broken the bottom of that M pattern. So you're looking for a move down to 110 because it is $20. Now, this particular M pattern, there is no early entry because the bottom comes all the way down. So unlike the other one, which flipped over as an M, would have looked probably more like this, and you could have entered there, you actually had to wait till there. But it's a nice, easy move. It's $20. It's very obvious. Once you short it, you put your stop somewhere in about the middle of it because either it works or it doesn't. And then once you get some profit, you can lock your position down to a break-even scenario. You hit your target. Very easy. Obviously, these are very important signals. Higher time frames mean more than shorter time frames. Keep that in mind. That's true with almost everything technical analysis related anyways. And it is a very profitable way to trade when you get these signals because they don't happen all the time, especially when they are at such obvious large figures like basically, and they don't have to be a perfect diamond. I just happen to be drawing one. They can look more like this. What happens is you get a run, and this is a top, obviously. This might be the bottom, diamond bottom. You get a run higher in the market, and then you start to form a couple of, it's like a broadening formation that we talked about a couple videos ago, but then starts to tighten back up. And then once you break down, what this tells you is that there's been a lot of soul searching in the market, so to speak. And suddenly there's bearish pressure that people are willing to really get involved in. And everybody in this diamond is trapped. So the market needs to break down. They need to cover their positions. In a downtrend, you can see the exact same thing, but then an explosive move up. And that, of course, is a diamond bottom. Now, there's no real measuring stick in these. A lot of people will try to aim for the height. That typically works out, but there isn't like a bona fide measuring stick, if you will, like you have with some other type of patterns that we'll be going through in this module. So let's take a look at what this looks like. I'll go ahead and pull up the trend line tool, and you can see that we have seen a lot of noise in this area, and I can draw trend lines like this, like so, to form the pattern itself. And, we're in a nice uptrend, and then we start to lose a little bit of confidence, and then we finally break back down. You can see that we test the midpoint of the triangle and then the diamond, and then break down from there as well. So the question is, what would you have aimed for? Well, this is about $8. So $8 from 73, that's got you right around 65-ish. And that's where you do end up. And now you've gapped lower and you're starting to see more resistance. So clearly that is a viable signal. Now here in Teva Pharmaceuticals, we have a bottom. And it's, kind of a sloppy, and some of these will be. You'll see this occasionally. I'll go ahead and extend this out just a little bit more. And there you go. It's a diamond bottom. And what's happened is we've sold off, and then there's just a lot of indecision, and then we broke higher. Now, something that I'll point out here, not to make this more complicated than it needs to be, because we got basically our height. But another thing, and you'll see this a lot as you go along, and this makes these type of signals even more important. Notice that we have higher lows going into the exiting as well. We continued the downtrend. That shows that there is still a bit of conviction. But the next time we make this higher low, then all of a sudden you've got people kind of wondering whether or not we can hang on. So a lot of that comes to short covering, and eventually we break out to the upside. Diamond patterns and tops and bottoms are a little bit more difficult to trade than some of the other patterns. The main takeaway here is you need to keep in mind that it's a loss of confidence in the overall. So a rounding top, as I'm sure you can imagine, is at the top of a move higher, and a rounding bottom is at the bottom of a move lower. It takes a little bit of artistic license to identify these patterns, but as a general rule, it's basically when, in the case of a rounding top, when the market does this, and a rounding bottom like this at the bottom of a downtrend at the top of an uptrend. So think about what this means. This means that the market has taken its time. In the case of a rounding top, we've rallied for a while. We've run into some resistance, but it's more like a lack of momentum. Perhaps the overall attitude of the market starting to change. Maybe some fundamentals have changed. Or there's just a simple lack of enthusiasm for a stock. And that forms, over time, this rounded top. We just kind of lose interest. Same thing with a rounding bottom. Been selling off, and then just gradually the selling pressure abates and we reach towards the upside. So when trading these things, you take the height of the pattern, you draw an imaginary line down here, and then on a break of what would be the neckline, for lack of a better term, or the bottom of the pattern or top of the pattern if it's a rounding bottom, you take the measurement of the height of the actual pattern itself and extrapolate the breakout. So for example, if this was $2 tall, once we break through this level, you're aiming for another $2. Your stop loss goes about halfway into the pattern, quite frankly, because if you get a breakdown and then you break back up into it, then it's not really sticking and it's just more kind of back and forth. So a rounding top can be identified as such. You can see that clearly the market has just tried to rally and this just couldn't hang on to it. And there's your pattern. The height is from 27 to 29.50. So that would be $2.50 from the breakdown from 27. So you're looking for 24.50, and that is exactly where you end up. You do get a little bit of a pullback, and you do get another chance to enter based upon this previous support. So sometimes you get that opportunity as well if you miss it. Rounding bottom, you can see that Yum Brands took its time, just kind of, we pulled back and then just kind of went like this for several months, from about 62 to 66, gives you a target of 70, which we do hit rather quickly. The nice thing about these patterns is they take a long time to set up, so you can keep your eye on them for quite some time. Also, something else that I would point out is the longer the time that it takes to form the pattern, the more impressive it will be, because it takes a lot more order flow to make these moves. In this case here, this would have been about 2.5 months over here, and the one in Microsoft. So a rectangle top is simply in an uptrend, an area where you get lots of choppy action, and you could put two trend lines that form a rectangle, and then a breakdown through that. This is also known as distribution. And that's because people who have accumulated a stock previously are distributing it to those who are foolish enough to buy it. This is where the quote-unquote smart money gets out. Just as a rectangle bottom or accumulation. And this isn't to say that accumulation can't happen in other shapes. It's just that that's what this is. It just happens to be in a rectangle. Then a rectangle bottom, we just have the exact opposite. Value hunters come in and take over. So think about what's going on here. You've got a trend, and then suddenly you don't. Most of the time, people will tell you that consolidation, which is what that is, leads to continuation. And most of the time that's true until it isn't. And then when it isn't, it becomes a signal that we're going against the previous uptrend and that something has changed. Stop losses are easy. You can either put them on the other side or in the middle, depending on how aggressive you are of the signal box. You're aiming for at least, so if it's $2 high, you're aiming for at least $2 on a breakdown below the support. Quite often, though, to be honest with you, we go much further than that. $2 in this case would be your minimum. So here we have Kellogg, and we had been in an uptrend, and you can see that we ended up forming a rectangle. We broke down, and it was the beginning of something rather negative. You can measure the rectangle, and you can see that we easily hit that and continued to go much further. And in fact, this ended up being like a 4 or 5 to 1 type of situation. So clearly that was an excellent sign. Here you have a rally and then a pullback. This pullback would have had people interested in perhaps trying to pick up Visa. You can see we have this huge rectangle here. We couldn't get to the bottom this last time, and we broke out. We retested it for support and continued to go higher. So this is about as picture perfect as it gets. You would take this from the level of the breakout, and you can see we got there rather quickly. But having said that, what's even more interesting about this one is that if you zoom way out, you see that this is a pullback in what had been an uptrend to begin with. So truthfully, the trade here was to hang on to it. As you can see, we continued to go much, much, much higher. These are great patterns. They don't happen all the time. But basically think of them as a failed consolidation pattern after a move up or down. Remember, unlike many of the other chart patterns that we discuss in this module, this does not have an inverse. But a cup and handle is pretty straightforward. It's supposed to represent a teacup. Basically, it's a rounded bottom, which you've learned before, and then it's got a little bit of a pullback and then eventually a move higher. It is a reversal signal. It's a bullish reversal signal. It doesn't happen that often necessarily, but it is something that a lot of people will follow. There is a possible measuring stick with it, but most people use it for a trend change period. They don't even necessarily try to measure it. They just take advantage of it. And think about the psychology that's going on here. We are in a downtrend and things continue to go a little bit lower and people feel better about it. And then it just kind of quiets down. Some people will take profit. Eventually more people will take profit. And then people will begin to be a little bit more concerned. We start to drift off. And then eventually we pick up some momentum and trading starts to pick up again, a lot of times with volume. And it just confirms a reversal pattern at the bottom of a larger move. So on this chart, I have a short-term cup and handle pattern. You can see that there's the rounded bottom, if you will. and then there's the handle. The handle always pulls back slightly, and then you get this massive amount of volume, and then Bitcoin just takes off. So there's a couple different ways that you could have traded this potential move. You could try to measure the cup and handle like this. So there's your handle, and then there's your entire height from 8,000 to 9,000. And then on the breakout above the top of that resistance barrier, you add 1,000 because it is $1,000 thick, if you will. And your target would have been 10,000. You can see that we did, in fact, have a little bit of a reaction there, but why wouldn't you? $10,000 is a very large round number. And then you just continue higher. You could have traded it that way. You could have put your stop underneath the handle. Some traders will just simply hold because they believe that these patterns, these cup and handle patterns, are so monumental that they just assume that the trend continues. And in this case, that would have paid off all the way to 11,750 before we got a significant pullback. You can see that there is a lot to be said for this pattern because it is complex. It takes so much time to set up. Remember, you've got all of that. It's not even really selling pressure. It is in the beginning, but after that, the market just seems to lose interest. And then there's another attempt to fall from there, and then it doesn't. So while the pattern is called the cup and handle, you could almost make it something along the lines of a downtrend followed by general lack of interest, another attempt to continue the downtrend, followed by a complete lack of interest. So think about the psychology always. You should always think about the psychology of what the participants are feeling on both sides. This high volume green candle that breaks out of resistance has the buyers feeling pretty good. At the same time, the sellers feel bad. They have to reverse their position, and then we continue to rally. Cup and handle is a pattern that matters more on higher time frames. But the cryptocurrency world is fairly new, so you don't see this a lot, say, like on the daily and certainly not on the weekly charts. However, it has its roots in the stock market, which, of course, a stock like IBM or, some of the other stalwarts like Amazon, Apple certainly conform these, and these can take place over weeks, if not months. Shorter time frames, of course, happen, like this example, and they do mean the same thing. And in the cryptocurrency world, that's wedges and triangles. It's kind of a broad topic, but they all basically mean the same thing. And what this means is that buyers and sellers are getting compressed and that we're meeting at a point. And there are a multitude of different types of both. There are at least 5 major ones. So for triangles, what you'll have is you'll have price compressing, bouncing around in 2 trend lines that are competing. This is a symmetrical triangle, and it is, like all triangles, a constriction of price, a constriction of energy, and needs to be broken by the time you hit the 80% of the way to the apex. So as we start this pattern, you draw 2 trend lines, and if you get past this 80% apex, then it loses its inertia and it just kind of peters out, so to speak. The nice thing about triangles, and this is going to be true with all of them, doesn't matter which flavor, 100 is, let's say, how many points or ticks or pips or whatever that this triangle makes. Once you break out of this in either direction, you measure 100 points from that trend line break for your target. There are also 2 other types of triangles that are quite common. There is the ascending, and this simply means that price is gradually going higher. It's running into significant resistance at, say, 900 here at a specific level. And this suggests that we are going to break out to the upside because the buyers are becoming more and more aggressive. As soon as we close above this trend, this sideways resistance line, we start to measure. Same thing over here. If it is 100 points or 100 pips or whatever, we're looking at a gain of 100 from the breakout. There's also the descending triangle, which is just simply sellers becoming more aggressive, and then finally they break through resistance. Once they break through resistance, you're looking at a loss of whatever the measurement is. Now remember again, we want to see this happen before 80% to the apex, the point at where these two lines intersect. So in this case, you can clearly see that there is an uptrend line being formed there, and there's resistance here in Amazon, and you can see that this $80 height right here was in fact hit. Pretty classic ascending triangle. Here in Citigroup, we had a descending triangle as shown by the trend line here, and the gap. You have to keep in this case, this is a little bit special case because the gap should be thought of as a big green candle. You can see we came down, we bounced a couple times, and then eventually broke down. You can also see clearly that we hit our target. So again, think about what's happening here. The sellers are overwhelming the buyers. The buyers finally give way. They have to close their positions, which just speeds up the process going forward, allowing for a fulfillment sometimes much quicker than you potentially think can happen. And finally, we have the symmetrical triangle. As you can see on Deer here on the weekly chart, there's a trend line there, and there's a trend line there. We break out above there. We're looking for, well, let's just call it $13. So $13 from the breakout of 80, I should say, is 93. And you see we did, in fact, fulfill that target. You'll see this time and time again. Triangles are by far probably one of the most commonly traded patterns. Now, I also mentioned wedges. And wedges are very much like triangles. There's only two that we'll focus on here. There is the rising and the descending wedge. And what's happening here is that we are getting buying pressure, but it's starting to tighten up like a spring. It's got a little bit of a tilt to it. That being said, when you break the down line, or the uptrend line, you break down through it, then you start looking for the bottom of the pattern, because these people who had been buying are running into overhead resistance and finally capitulate. Same thing with a falling wedge. We're falling in the market, and then all of a sudden, for whatever reason, the sellers run out of momentum, and we start aiming for the top of this pattern. These are relatively common patterns. They aren't as common or as highly traded as triangles, but they are worth paying attention to. So here in John Deere, we have a little bit of a rising wedge here. You can see that there was certainly upward pressure here on this trend line. And you can definitely see that there was a bit of resistance here at this trend line. And look what happened. We ended up breaking through it on this candle pretty quietly. It wasn't as eventful of a move that you would think. And then we drifted lower and then gapped down to hit this figure here. And here we have a falling wedge in Goldman Sachs that you can see there's a little bit of a trend line there. And there's trend line there. Well, we break through it. Not only do we hit this target, but we gap into it and continue to go much higher. So these are, relatively common patterns. I would say, of course, triangles are probably more reliable than wedges just because they're easier to spot. Wedges tend to be, a little convoluted at times, and sometimes you have to use a little bit of artistic license. Now, flag and pennant patterns are very similar. They will have, there's two versions of each. They will have a run higher, and then there will be consolidation of one sort or another. And as I'm sure you can imagine, that's what makes the difference. So In a flag, you'll see a small pullback in a bit of a channel, and in a pennant, you see more of a triangle after a move higher in a bullish version. Now, there's also the bearish version, which is the exact opposite. Basically, you're looking at a run lower and then a slight pullback in a channel, or a run lower and a triangle. The beauty of these patterns is that everybody in the world pays attention to them, basically, and they're obvious a lot of times. They also come with a built-in measuring stick, so what you'll see is, with a pattern like this, a lot of times people will enter on a break of the flag, and you measure from the run up to the top of the flag. If that's $10, well, you're aiming for $10. Your stop loss, of course, is on the other side of the pattern. If that gets broken, then it invalidates everything. In the pennant, let's just say it's $8 on a break higher. You're looking for 8. Now, of course, it works in the same way, but lower. A $5 pull, if you will, of the flag. You break down. You're looking to match the length of the pole. $6 pull on the pennant, you're looking for $6. It's pretty straightforward, and they're very obvious, and that's why people like them. You just put your stop loss behind the consolidation pattern, and you let it rip. So with that in mind, let's take a look at a few examples I have marked up on the charts. This is Hyatt, and this is a bullish pennant because you can see that we clearly had a downtrend line and an uptrend line after a run higher. This pull, if you will, is from 38 to 43. So it was anticipated to be a $5 run on the breakout. So we're looking at about 47 and a quarter. And you can see that we did, in fact, hit it. Took a while to get there, but we did, in fact, hit it. And in fact, most people would have been happy taking profit at the sign of trouble there at a shooting star. So you may have missed it by a quarter. But essentially the same thing, nice gap higher. Over here in Zillow, we have a bearish pennant. You can see it was hit 3 times there, 3 times there. Kind of poorly drawn on my part, but it is there. You can see that the pull was roughly a $7 pull, so you're looking at $48. You hit that rather quick, right about here, probably about 4 or 5 days after the fact. Philip Morris formed a bullish flag here. You can see we ran higher and then we consolidated, slightly pulling back. So you're looking for the height of the flag, 87 to 92. So it's $5. We break out during this day. $5 above 92.5 is 97.5. And you can see that we get there and, of course, continue to go higher. And here in Google, we get a bearish flag, nice run lower, and then we just kind of consolidate in this channel for a while. We gap lower, and if you had this pattern already marked out on your chart, you would have known what to expect on the move to the downside. You just take this, extrapolate it. You can see that we did eventually hit the target of about 247.5 after this huge move that, of course, did take a couple of months, but it was such a large move that it certainly was extraordinarily profitable. And again, like wedges and triangles, these are patterns that show up on all time frames, and they're very popular. So you will find that they have an extraordinarily. So the phrase "dead cat bounce" comes from the idea of that even a dead cat will bounce if the market falls quick enough. And this is simply because we can't go down forever. But you need a massive sell-off to have this phenomenon happen. Typically, you'll get a bit of a bounce and then perhaps some continuation. If you lose, say, 15% in one day, it's impossible to keep going down like that. Eventually, there will be short sellers taking profits. There'll be people jumping in trying to pick up the stock on the cheap kind of thing. But if the negative momentum continues, you can get continuation. At the very least, you can get a retest of the lows. And in front of you, I have a chart that shows 2 of my favorite strategies for dealing with dead cat bounces when it comes to day trading. Now, I'll bring your attention to the gap lower to kick off the day here on the 25th. As you can see on the chart, we just fell apart. So there's a couple things that you need to pay attention to. First thing you have to ask yourself is, have we passed any major previous resistance? And we did, in the form of this gap. So obviously this gap should translate into resistance again now that we've broken through it. It should have been support, but you can see that did not happen. So a couple days later, in that same area, you can see that we rolled over. And at this point, you have to ask yourself, okay, so what was the clue? Well, the clue was this area and this massive candle here. It isn't quite an engulfing candle, but it most certainly shows an extremely long red candle and bearishness. And in fact, we went right back down to the lows, a few cents or so. So that's the first way you could have played this. You could have just noticed, where do we blow through? Because it's difficult to jump into this market here. Matter of fact, you can almost always count on losing money. But you recognize this gap, and you recognize that it could give you an opportunity. And you got it there. And in fact, you could have even entered from this candlestick if you gave it enough of a stop loss, perhaps above the top of the gap. So either one really would have worked. But once we rallied and tried to take this out and then failed again, that was a sign that you were going to go lower. So you short on that candlestick, and for the rest of the day, the market does nothing but fall. That's one way you can play these. Another way, of course, is using a Fibonacci retracement tool. And you can see that the same reversal, this candlestick here and this gap, lined up quite nicely with the 50% Fibonacci retracement. The main takeaway from this should be very patient. Look for an area that makes a lot of sense to cause problems for the bounce. And this typically means, and at least in day trading, that it's actually a trade you take several days later. That's very common, because it's really rare that you're going to fall like that and then turn around and bounce right back up there on the same day. If you do, then you have an extraordinarily volatile market that you should probably stay away from. But a bounce like this is very sustainable. It's very reliable in the sense that eventually it will roll back over. And once it does, it should, at the very least, try to test this bottom. Trading dead cat bounces is a bit difficult on the short-term charts, and that's another reason why you need to be so patient. You could even make an argument for a downtrend line there that we had tested and failed at, because there were 3 hits.